Good morning. Good morning. I'm Greg McKenna. It's Tuesday, the 29th of September, and here's your morning market report. It's going to be a tough day for traders in Asia today after big falls on Wall Street last night. The Dow lost over 300 points, or almost 2%. The Nasdaq lost 142 points, or more than 3%. And the S&P was down the best part of 50 points for a 2.5% loss. That's taken the S&P down below its recent range. It's broken the Nasdaq's recent range, also triggered a death cross in the Nasdaq. So that's 3 for 3 from the big US indices. It's also pushed the Dow and the FTSE right onto recent range support. The DAX is broken and is very close to breaking the August lows. It's probably the most tenuous stock market out there. If you remember a couple of months ago in my Go Markets report, and since I started doing these morning reports, I said 9,000 was my target over a couple of months for the DAX. It's at now 9,400 now. So it's going to head lower. I think it's probably going to head to 7,500 or something like that. You've got the VW scandal, you've got other issues in Europe, and you've got an overwhelming sense investor caution, pardon me, but it's got to take out that low. Once it takes out that low, then we can start to focus on the downside, but it's got to take out that low first. The key thing for me is that there wasn't any particular catalyst last night. Of course, the big fall in Chinese company profits yesterday, down 8.8%, a huge acceleration from the down just below 3% in July. That's a bad sign for the Chinese economy. On Business Insider this morning, we've got a story from Barclays showing that they've just sent an analyst back, and he's uber bearish and says the easy money era in China is gone. There's a couple of things in that. One is it's going to be difficult for foreign companies to easily extract cash from the Chinese economy, and the other thing is that foreign direct investment has dead stopped. With the stop in foreign direct investment, then you get some issues for what's going on in the Chinese economy, how they fund themselves, all that kind of stuff. Of course, they've got plenty of money, but it just means that they're more reliant on internal demand and internal drivers and internal stimulus. Now, there was talk of stimulus yesterday. One of the mouthpieces for the Chinese government said that there was more stimulus coming, and it looks to me like there will be. So perhaps we'll get some more on that today and turn sentiment in global markets around. We've seen some range breaks, but we've still seen the August lows holding, even for the DAX, but they're the levels to watch. Now, the big impact of all that was that the Aussie dollar is back down below 70 cents. That makes sense. It's at 69.77 today after getting up to 70.40 last night. But what's interesting is that the yen is still 119.91. You'll know that I keep saying that I think it's going to 116.5. I definitely think that's the place. Now, what you'll see, if it does go to 116.5, as I bring up my chart, if it does go to 116.5, which is the low, hopefully you can see the cursor there, which is the low from August, it's also going to test the bottom of this uptrend that goes back to, the 79s, 80s when Abenomics first kicked off. Now, it makes very little sense for the yen to be strengthening, but for years now, decades even, the yen has been the primary foreign exchange market. So what we get at times like these is we get this move in the yen. Now, let me just quickly talk about the Aussie. This bit here, I've highlighted this in my Go Markets report this morning. This trend line goes all the way back to the September 11 low in the Aussie. We failed at 72.85 twice just after the FOMC. We had a base below 69 cents. We bounced off 69.39 last week. Still intact for the moment, but from an overall point of view, we're seeing a time consolidation before it looks like the Aussie goes down again. But I'm not going to get too bearish unless or until those levels break. Now, the reason for that is the volatility works both ways. You've seen Oil crashed again last night, and it's now back in the 44 buck range, 44.5 this morning. You know, it's been up to 46 or 47, it's been down to 44. It's been up to 46 or 47, it's been down to 44. The Aussie's been 69.39, back up to 70. It's been up to 72. Euros in a couple of cent range. The S&P in a big old range. You know, those kind of things. Lots of ranges at the moment. The key, I think, though, at the moment is also that the Fed tripled down last night. 3 speakers, all talking about the possibility of rates moving this year. And Williams from San Francisco, who many see as a mentee of Janet Yellen, really did say that October was live. Now, I don't believe for a second October is live. They should have gone in September. You know, they've really screwed this up. But anyway, the reality is that they're trying to keep it on the table because they're trying to keep as much credibility for themselves as they can. The problem is they've lost the window that they had. And so as people get concerned about global growth, and the IMF is apparently going to downgrade global growth in the World Economic Outlook that's out in October, as they talk about growth, as China continues to weaken, as we get those stories about US companies struggling in China, as we get concerns about Q3 earnings, it feeds on itself when the Fed says we're going to tighten anyway. That's the problem. That's the conundrum that they have right now. So we'll have to see what happens there. But as things flow today, there's not a lot of data out. It's a bit of a data-free zone. We've got consumer confidence, the weekly ANZ consumer confidence. So we'll see if Turnbull's bounce has held today. Apart from that, we've got some German data and Case-Shiller tonight in the States. It's not a big night. So enjoy the next 24 hours because everything kicks off again tomorrow with the release of market PMIs. We've got the Australian one obviously at 9:30, the PMI from the AI group. Then we've got the Chinese one, and then we've got Japanese as well, and then we go around the world. So we'll get a real sense of where manufacturing is. The global economy is more than manufacturing. A lot of it is services, particularly in the developed countries, but the market focuses on those manufacturing. So that's going to be key tomorrow. In the meantime, expected down day for the ASX today. It's at 5,000. 4965 is the key level to watch. I highlighted that this morning in my Business Insider 20 seconds piece, which I'll just bring up so you can have a look. And then I'll say, have a great day. So you can see here, 4965 is the key level. You've got to expect that there's a real chance that that's going to break today, given what's happened in the S&P and that sort of stuff. The Aussie market has been marching a little bit to its own drum, trading up and down in that range, but a break could be decisive. So watch that level today. Watch the Aussie dollar. We haven't broken down yet, and the August lows have held in everything, including oil. But watch out. One of the key things to remember is that people wanting to hedge inflation, so hedge against deflation, the price of that went up last night. That's consistent with why gold's down, even though it makes no sense to me in a risk environment why gold might be down. But if you're thinking about deflation, then you're not really worried too much about gold. You can buy nominal bonds. Nominal bonds are the best hedge against lower inflation or a potential deflationary environment. Now, one more thing. One day's everyone's happy. The next day, everyone's in the doldrums. There's volatility in emotions and volatility in markets. So we all need to be careful, respect the levels until they break, but today's probably going to see some weakness in stocks. And as a result, the Aussie and commodity currencies will continue to be a little bit pressured. So have a great day. I'm Greg McKenna. I look forward to seeing you again tomorrow morning for the morning market wrap. So have a great day and bye for now.